Okay, so this is the last of the lectures on this second topic, and in the next 2 weeks, we will be talking about the third topic, so the choice of essentially exchange rate regimes, and we'll be focusing on one of the possibilities to go for a currency union. Yeah. And of course, we will be talking about Europe, but we will try to make it a bit more general. So talk about so-called optimum currency areas. So again, I mean, as with all of these topics and things, there's a huge literature out there. I'm just going to introduce you to the material. There are good readings on Blackboard. There's a lot more. So those of you that have read, digested all the readings, if you want more, just let me know and I'll give you a lot of extra stuff. But it's going to give you a flavour of the second and third generation models, and the reason why they were developed, because there were new crises that didn't quite look like the first generation crises based on government deficits and debt. So that's the plan. Briefly, sort of giving you the basic idea behind second generation or Mark II models of currency crisis. Talk about the UK and its infamous exit of the ERM on the 16th of September 1992. And then move on to third generation models and talk about even greater, more calamitous period of currency crises, the so-called East Asian 1997-98 financial crisis. In terms of GDP losses and unemployment and riots and poverty, the UK crisis was really nothing compared to what happens to these economies. Right, so here's the basic idea of second generation models. So the first generation models, or the Mark I models, they're emphasising these fiscal issues. And they're relevant because over and over again in the 70s and 80s, this seems to be the major problem. It was causing the abandonment of the peg. But the second generation models are really emphasising something different. They're saying, okay, it's not so much that you're being incompetent and consistently spending more than you tax and running deficits. It's more than you tried to fix your exchange rate against another currency because you kind of accepted that in the past you as a government / central banker have not been able to deliver low inflation. So you have tried to delegate this crucial decision about monetary policy to a more responsible low inflation creating central bank. But you're of course also trying to make sure that you achieve other objectives in your economy. In particular, if you think about what I taught you last year, for most of you that did second year macro, the key aim is really to keep, yes, inflation at a low level, but also to make sure that output is more or less equal to the natural level. So make sure that unemployment is at its natural level, that output is at its natural level, and every time the economy is faltering, so it goes into a recession, you would want to use policy, fiscal and monetary, to try to counteract that. And so the problem arises when your exchange rate peg, which is effectively there because you want to keep low inflation, is going against your objective of economic activity. And markets, the hedge funders and so on, they just understand this and say something will have to give, and we believe that because unemployment and so on is going to be deemed more important than keeping this peg, we believe that they're going to abandon this commitment to a fixed exchange rate sooner or later. So formally, although I'm not going to do it formally at all, you can do this sort of stuff and get the results of the second generation model by using exactly the same framework as we used last year. So you have this subjective function is often modeled as a quadratic objective function, where you try to minimize the deviations of inflation from target, so the pi should be as close as possible to your target, say 2%, and you also try to minimize the deviations of output from the natural level. And so you're trying to achieve these two things at the same time, but you do that subject to a Phillips curve that gives you a trade-off between the two, inflation and economic activity. And what's going to happen is that what you choose depends crucially on society's preferences towards the two things, as well as the long-term costs in terms of lost credibility versus the short-term benefits. So every time speculative attacks are successful, as they were on Black Wednesday for the UK, it's because the markets anticipate that the short run gains outweigh the long term costs of abandoning the peg. So here's in a little bit more detail what I mean by this. So suppose this could be the UK in 1992. The economy is in a recession. So YT, current economic activity, is below its potential, its natural level, the Y bar. Now, everyone knows that with a fixed exchange rate and with a small difference in inflation rates, the economy is not going to get out of the recession through a sudden increase in net exports. That is, there's no reason why suddenly people would want to buy a lot more of the British products. And so if this real exchange rate doesn't change because inflation rates are very similar and the nominal exchange rate, our S, is constant, then the economy is going to remain in a recession. This is particularly true if there is no leeway when it comes to fiscal policy. Yeah? But markets also know that one way to get out of a recession, of course, is by stimulating net exports. And the way you do this, of course, is by having a real exchange rate depreciation. And that can happen, of course, if one of two things. In a flexible exchange rate regime, the currency depreciates substantially in nominal terms, and hence because of price rigidity in real terms as well. In a fixed exchange rate regime, which is what we're focusing on, this will happen if the currency is suddenly devalued. So, before the crisis, £1 was buying 3 Deutschmarks. After the crisis, if £1 is only buying 2.7 Deutschmarks, then British products will become more competitive relative to German products, and that should tend to increase exports and decrease imports. Yeah? And so this is what markets anticipate. They're just, these guys, as you saw, they get very excited with the prospect of making a lot of money by buying and selling assets. So they're really looking into these things and saying, this is clearly a realistic possibility for this government. So I bet that sooner or later they're going to devalue the currency, and I'm going to try to make money by selling now and then buying the currency later on. That was what, of course, George Soros and other hedge funders did. Yeah? So you sell dear and you buy cheap. And so, in many cases, these attacks are successful and the peg is abandoned. Now, what does that mean for our equilibrium in the foreign exchange market? So let's go back to our standard equilibrium condition, which is, it's one of the key elements, building blocks of all of this Part A syllabus. Uncovered or augmented uncovered parity condition. It tells us that your people will only be happy to hold, in this case, UK assets and German assets at the same time if they're broadly giving them the same return when measured in the same currency. Now, if the peg was totally credible, if this was a hard peg, so very, very difficult to devalue, mainly because you're on a so-called currency board regime, then it's just not credible to assume that people expect the exchange rate next period, next month, or even on tomorrow, to be different from the official peg, the S-bar. And so, when that is the case, if there's very little risk that the home authorities are going to abandon the peg, then, as you can see, interest rates at home will broadly be equal to the interest rates in the foreign country, in the anchor country. In the example of DRM, Germany, of course, West Germany, and then Germany after the reunification. And so, the more credible the system, the more likely it is that the interest rate is going to, at home is going to be very, very similar to the interest rate abroad. But of course, what tends to happen over and over again is that the credibility is never 100%. And so, even though the peg may have been successful for 5, sometimes 7, 8, 10 years, on average, the countries that are pegging against the anchor country will tend to still be paying high interest rates. And the reason for this is because this term is never quite equal to 0. Yeah? So I'm going to be focusing in my example on the British pound, but of course the Italian lira was also pegging was also pegged against the Deutschmark and several other currencies, the Spanish peseta and so on. And all of these countries had interest rates which were higher than in Germany. Logic, all the markets knew that these were soft pegs, they were committed to keeping their exchange rates at a certain level against the Deutschmark, but if there was an attack or particular crisis, they could abandon it. And so they place a probability on this being positive, and that's why they require a higher compensation. Is this all right, everyone? Well, that's what I wrote in here. Now, there are two things that are going to make this difference between the home interest rate and the anchor country's interest rate bigger. The first reason is how big is the so-called misalignment. For those of you that looked at the have seen the documentary, even the head of Germany's central bank, the Bundesbank, realised that when the UK decided to enter, this was John Major's decision as Chancellor of the Exchequer at the time, enter the ERM at that particular rate, so it was about 2.94 Deutschmarks per pound, many people thought that was too high. That is, effectively they were saying, this is not quite the right exchange rate. With this sort of exchange rate, the British exports will still not be that competitive. Britain is going to carry on running trade deficits. It might be a better idea to go for a higher interest rate, in other words, for a lower value of the pound. Yeah? But of course, that wasn't what happened. And what this means is, what this meant was that many, many markets from the start, from October 1990, when once Britain joined this exchange rate mechanism, they were speculating that the fixed exchange rate at the S-bar was not really the right one. In other words, if you want the long-term sustainable exchange rate, what I've been calling in these lectures the S-bar T plus N, was just substantially different from the actual peg. And because of this, they're saying they're thinking this is the wrong decision. Sooner or later, these guys will have to devalue. And I'm going to bet this is going to happen. This is going to happen pretty soon. So the bigger the disalignment, the more likely it is that you'll have to pay high interest rates for your domestic assets. And of course, the greater the probability of devaluation, which is, for example, going to depend on the extent of the economic crisis at home, the more likely it is that this term is going to be big, positive and big. Yeah? So this is very important because it shows that with these soft pegs, you commit to a fixed exchange rate, but it's a soft peg in the sense that No one goes to jail if they decide to throw their hands in the air and say, sorry, we're out of this system, we're going to devalue.